All throughout our working lives, we save for retirement, hoping that it will be enough to support the retirement we've always dreamed of. This is no easy task, and there have been several approaches to determine how much is needed in retirement savings. One popular approach is Bengen's 4% rule, which estimates a maximum 4% withdrawal in order to not deplete the entire portfolio. The question is, does this rule really work in determining the amount you need to save and withdraw for retirement in today's environment? In this video, I'll discuss the 4% rule of thumb for retirement savings withdrawal and analyze whether it is really a good way to know if your total portfolio would be enough to sustain when you eventually retire. Hi, my name is Darius Muica, a senior investment advisor with Noor Private Wealth. If you are new to my channel, we focus on helping our clients build wealth in the most tax-efficient way possible, so let's jump right in. It's been more than 25 years since Bill Bengen, a financial advisor in Southern California, created the popular retirement 4% rule. The idea behind this rule is to ensure that you don't outlive your retirement savings. This rule suggests that if you want to ensure that your retirement savings sustain you throughout your retirement period, you should budget to spend a maximum of 4% of the balance in the first year, adjusting this amount each year for inflation. For example, if you have $1 million by the time you retire, you should withdraw $40,000, which is 4% of that amount, in the first year. This amount would then be adjusted in the next year for inflation. So how realistic is this rule in current times? And could it be that the method which Bengen used to arrive at this rule that has persisted over time was too simplistic? In recent times, he has allegedly attested to the fact that the 4% rule was historically just the worst case scenario, and that also it was created to withstand 30 years of withdrawals if the money was invested in October 1968, which was the worst time for somebody to retire with the market at its peak and skyrocketing inflation. Bengen's 4% rule was based on a conservative portfolio with 50% bonds, 30% large caps and 20% small caps. The 4% rule was created 25 years ago when the 10-year US government bond was paying 7.88%. The same bond in 2020 reached at its lowest point 0.52%. That being said, the challenges we face today are quite different compared to when Bengen derived the 4% safe maximum retirement withdrawal amount. Now, the valuation of stocks is higher while we have lower yield interest rates for bonds and relatively lower inflation. Because of the low yields, the traditional 50% allocation to bonds just doesn't cut it anymore. After fees and taxes, bonds will have a hard time keeping up with inflation and generate the returns your portfolio needs to be sustainable. Understanding the challenges with bonds is a very important conversation I have with every client. The main challenge of having less bonds is volatility. Volatility is inevitable in the stock markets, but it works in your favor when you are building your wealth in the long run. This is so because you are a net saver, and every pullback in the market gives you the opportunity to buy at discounted prices. On the other hand, when you make retirement withdrawals from the portfolio, volatility works against you. For example, if you have a retirement portfolio of $1 million with $50,000 withdrawals annually, let's assume that the market drops by 50%, bringing your portfolio to a value of $500,000. If it takes 5 years for the market to recover, in a worst case scenario, half of your portfolio can be gone due to market volatility. This is because you have been taking $50,000 out of your retirement savings per year for 5 years, leaving only about $250,000. This portfolio balance after the rebound will be around $500,000, or half of your retirement savings gone in a worst case scenario. Due to the market volatility, we recommend enough bonds in a retirement portfolio, up to 20-25%, to cover 5 years of cash flow needs. This will cushion the impact of the market volatility and make sure that while withdrawing money to cover lifestyle expenses, you are not selling at a loss. The difference should be invested in stocks and alternative investments that will generate higher returns in the portfolio. But are 5 years of cash flow needs enough? Well, there were 33 business cycles in the United States between 1854 and 2009, based on the National Bureau of Economic Research. The average length of a growing economy is 38.7 months or 3.2 years. The average recession lasts for 17.5 months or 1.5 years. A full business cycle on average is 4.7 years. The longest contraction or recession of record in the United States was the Great Depression in 1929 that lasted 43 months or 3.6 years. The second longest recession was the Great Recession that we all experienced in 2008 that lasted 18 months or 1.5 years. Looking historically at the business cycles and recessions, if you have 5 years of withdrawals that are sheltered in bonds, you should be good. Although your stock portfolio will go down with the market, any good stock won't stay down, it will eventually recover. In essence, Bengen's 4% rule still holds today, but it needs to be tweaked. Lower exposure to bonds and the introduction of alternative investments are needed in order to ensure the sustainability of retirement savings. Despite the low interest rates, retirees right now have one saving grace: very low inflation. It was inflation more than the bear markets in stocks and bonds that really crushed retirees in the 1970s. And inflation is worse for retirees than bear markets because a market pullback eventually comes to an end and stocks and bonds recover. But when prices go up, they rarely go back down to where they were before. When you get inflation, it gets locked in and you're stuck with the higher prices for 30 years. In a paper published by Vanguard, they built on the 4% rule concept and they created the Vanguard Dynamic Rule as a more appropriate approach in determining retirement savings withdrawals. This approach involves setting a floor and a ceiling for withdrawals. The floor would be the minimum you need for your lifestyle and apply that during market corrections. For example, a moderate investor who wants stable inflation-adjusted spending with a 30-year time horizon can set an initial portfolio withdrawal rate of 4%, assuming an 85% chance that he or she will not run out of money. If that retiree can cut spending by 2.5% in years when the markets are performing poorly, he or she could set the initial portfolio withdrawal rate at 5.1%, which is 1.1% higher than the previous example. In short, when choosing a floor and a ceiling combination, there are trade-offs between maintaining the desired level of current spending and preserving the portfolio to support future spending goals. In selecting a floor and ceiling, retirees and their advisors must have a solid understanding of their income and expenses. The more they can tolerate some short-term fluctuations in spending, the more likely they are to achieve their longer-term goals. That's it for today's video. I hope you found it valuable, and if you haven't done that already, make sure to hit the like button, and if you want to see more, don't forget to subscribe. If you have any questions or comments, please let me know below. I read and reply to every single one. Thank you very much for watching, and I will see you next time.